In this lecture, we're going to focus our attention on IVICs, on individual variable insurance contracts. And as I stated before, another name for those, of course, are what we call seg funds. So individual variable insurance contract. And from time to time, you're going to see the word seg funds or segregated funds. Today's lecture will really be focused on the guarantees in regards to variable insurance contracts. Okay, this is really what a segregated fund really is the insurance company's mutual fund products. So this is one of the unique features, you might say, of the particular funds that are not available on mutual funds. And what we've got on segregated funds that are not available on mutual funds is these guarantees. There are two guarantees that you actually have. We have what's called the maturity guarantee, and we have a death benefit guarantee. Let's talk about the maturity first. First of all, I would stress to you that the word maturity means 10 years. Basically, from the date that the person actually made a deposit. So, for example, they deposited in July 15th, year 2000, let's say. Well, July 15th, year 2010 will be 10 years. So it's really a 10-year contract. So that doesn't mean that they have to take out the money at the end of 10 years. What we're saying is that it matures at that particular time. Something unique happens, okay, at that time. So the maturity guarantee at 10 years, what happens is that the insurance company must refund back to you, must give you back no less than 75% of whatever amounts of money that you actually put in. So regardless of the market conditions, whatever happened 10 years from now, so going back to our example of July 15th, 2000, and now July 15th, 2010, if the individual gave us $10,000 to start off with, and let's, for example, say that the investment actually went down to $5,000, the insurance company has to top it up to the 75%. In other words, what you're guaranteed is 75% of your deposit. So in our example, what we've got is $10,000 that the person gave us July 15th, the year 2000. Then at the very, very least, 10 years down the line, they're going to get 75% of that $10,000. In other words, $7,500. Of course, if they have more, they're going to get more. But the maturity guarantee is that we're not going to give you any less than 75%. So regardless of what happens to the market, the worst case scenario is the consumer is going to get 75% of whatever amounts of deposit that will be made during that particular 10-year period of time. Also, along the way, during that 10 years, if the individual, in fact, dies along the way, then we also have what's called death benefit guarantee. And once again, whenever that individual dies, if that person dies in the 5th year, once again, that the very worst case scenario is they're going to get 75% of the money that they've actually deposited up to that point. So once again, in our example, the individual gave us $10,000. The day he died, it was only worth $2,000, okay? Then the insurance company has to top that up because 75% of that $10,000, so that's $7,500. So if they've only got $2,000 in the pot, the difference between the $2,000 and the $7,500, in our example, the $5,500, the insurance company will have to top it up. Once again, if the amount is actually higher than 75%, then there is no guarantee because the insurance company simply pay out the higher amount. But a worst case scenario, whether it's on the 10-year net maturity or anytime that person dies within that 10 year, a worst case scenario is they're going to pick up 75% of whatever deposit that they've made during that period of time.